Do you know when housing in Canada was least affordable? Well, that's easy. The period of time during which the housing in Canada was least affordable is. If we're meeting for the first time, my name is Vlad. I'm a real estate agent with the Purple Tree Real Estate Group in Toronto. And on this channel, we're dedicated to providing you with the latest and the most accurate information on what's happening in the real estate market. Before we get into the main topic, let's just say a few words about the Canadian mortgage scene. Can we call it a scene? Well, for sure, there's been a lot of drama over the past couple of years. Let's take a look. Canadian mortgages just had one of the slowest quarters ever. And the Bank of Canada data shows residential mortgage credit slowed even further in Q4 2023. The unusually slow quarter revealed households accumulated mortgage debt at one of the slowest rates ever as interest rates divert capital to areas outside of housing. So there's been a lot of conversations over the past few years that Canadian economy is very lopsided and that a bulk of the investment that is being put into the Canadian economy goes towards real estate. And there's a good reason for that. It provided good returns over the past 2 to 3 decades, and also it has been relatively low risk. So instead of investing into other areas which could be considered by a lot of investors as risky ventures, maybe high tech or maybe manufacturing, people have been disproportionately allocating their investment money to invest into real estate. Canadians are accumulating mortgage debt at an unusually slower rate these days. The balance rose just 0.047% to 1.8 trillion in Q4 2023, about half the rate of the prior quarter. The rate was also the lowest growth of any quarter since 2019 and the slowest Q4 reported since 2008, back when it was in full-blown contraction. So people are just not going out and getting mortgages. And again, we are putting everything into the same bucket. On the one hand, banks may not be as easy with issuing mortgages as they were before, given new regulations that are coming into play seemingly every single year. Plus, of course, the higher interest rates and the stress test of 2% over the prime rate does not necessarily help. And the second part is that people just simply don't feel like they have the money to maintain the expense associated with owning a house. So 2 reasons for that. And of course, there's a massive contraction in the number of mortgages issued. The slow pace of mortgage borrowing has been a broad trend over the past year. Annual growth of 4.18% plus 72.47 billion in Q4 marks the smallest number since Q1 2019. As for annual growth reported in the fourth quarter, one has to go back to 2009 to see a slower year-end number. So mortgage issuance has been slowing down in Canada in 2023. Now that the data has come in, is a good indication of that. So, if we look at the Canadian mortgage growth, and that's annualized on a per quarter basis since 2015 up until last quarter of 2023, we see that we are in the lowest position during this period of time. And the last point that the article is making is a critical issue. Canada's real estate dependent economy has played a significant role in creating what the central bank calls a productivity crisis. Productivity in Canada is not growing at a pace of other countries in the Western Bloc. With easy, relatively low risk profits driven in housing, there has been little reason for investors to invest in higher risk innovation and manufacturing growth. An issue that's having knock-on effects such as motivating one of the biggest capital flights in the country's history. Yeah, so that's a recent article based on a report that talks specifically about Canadians selling their assets in Canada outside of real estate. It makes sense to stress that point, and actually moving them elsewhere. All right, next article on better dwelling has to do with the rate announcement from earlier this week from the Bank of Canada. And based on the title of this article, the BOC delivered bad news for mortgage rates because yields ended up surging. So let's read on. CPI, Consumer Price Index, slowed to 2.8% in February, and core CPI cooled to 3% over the same period of time. Remember, the target that the Bank of Canada announced a couple of years ago for the CPI inflation was at 2%. So we're still some ways off, and the closer we get to the target, so-called last mile, the more difficult it gets to actually get there. So it takes longer, and often more radical measures are necessary. So they see slower progress in the coming months, though, forecasting it will hover around 3% in the near term. They still believe a 2% target can be reached next year, but a number of factors are creating upside risk. And inflation could be higher if global tensions escalate, and this boosts energy prices and further disrupts international shipping, explained BOC Governor Tiff Macklem. There's a good reason for concern here. Global tensions are at one of the highest levels we've seen in probably almost a century at this point. It is highly probable that they will escalate further, they will bring energy prices further, and that will not help inflation in Canada, or getting to the coveted 2% that the Bank of Canada has declared as the target. Households looking for cheaper mortgages got the exact opposite today. The Government of Canada 5-year bond saw its yield surge as high as 3.73% on an announcement before settling around 3.69 midday. So the bond market for 5-year bonds is telling us, or predicting specifically, which direction the 5-year fixed rate is going to go. And based on this, there's a direct tie-in between the bond yields and the 5-year fixed mortgages. 5-year fixed mortgages are going up. Governor Macklem highlighted the stalled growth in the second half of 2023, along with rising unemployment and moderation for wage growth. So the BOC expects Canada to see some signs of improvement in the coming months. Real GDP growth is forecast to climb 1.5% in 2024 and about 2% in 25 and 26 respectively. They see this improvement helping to absorb the excess supply over the next few years. Well, even though the GDP growth is ridiculously low as compared to other countries, say in the G7. But at least we are predicting growth and not a recession or a depression. So GDP is going to be growing, and that's another indicator for the Bank of Canada to be very circumspect about lowering the rates in June. And in closing on this article, we don't want to leave monetary policy this restrictive longer than we need to. This is the words from Macklem. If we lower our policy interest rate too early or cut too fast, we could jeopardize the progress we've made bringing inflation down. So very, very careful in their considerations on what to do with the policy rate. And it's far from being a guarantee that the rates in June will start going down. And now we're at a point in the video where I can talk about the question that I posed earlier in the conversation. When was the least affordable time to purchase a house in Canada? And this next article is going to tell us exactly that. Canadian real estate has never been less affordable, and low rates don't help. Canada's largest bank warns it's never been more difficult to buy a home in the country. RBC warns a median household would need to spend up to 108% of their income to purchase a median home in cities across Canada. Canadians are overloaded with debt in general, and on top of that, in the province of Ontario, it takes more than 80% of a family earning a median income to maintain their housing-related expenses, and in the province of British Columbia, it's in excess of 100%. So my guess would be that when they're talking about 108%, some pockets within the city of Vancouver perhaps are actually reflective of this number. 108% of their income to purchase a median home. Well, guys, once again, we're at the crossroads. Economists cannot agree on how this real estate market of ours is going to evolve between now and the end of the year. Case in point, RBC came out with a report just about a couple of weeks ago where they're saying that the real estate prices are going to continue staying reasonably flat between now and the end of the year. And in 25, there's going to be a marginal increase in prices. They're thinking about something to the tune of 3%. So that's one data point. Now, I decided to look at what CMHC is telling us in a report that came out at approximately the same time. And their predictions are bold and exuberant. They're thinking that over the next year, the real estate prices are going to go up by as much as 20%. And you're looking at those two data points and you're thinking, who is right here? And I'm thinking to myself, the future is as murky as ever. So instead of listening to pundits and economists that are telling you to do this or that, I think instead you should be relying on your own judgment and your own circumstances. As always, if you're not sure about how to position your property for sale, if you're thinking about selling this year and the market is still very difficult, or you're thinking about purchasing something, you're not sure about how to go about the buyer's journey, I encourage that you have a conversation with either myself, Vlad, or my partner, Mitra. The link to our calendar is in the description below. And the process is simple. You connect with us through the calendar and we'll schedule a 15-minute phone consultation with you where we're going to talk about the specifics of your circumstances. And if you want to hear a more in-depth conversation about housing affordability in Canada, you absolutely must watch this video.